Okay, real quickly, Apex does not allow hedging. Everywhere else does. Watch this short little video explaining what kinds of hedgings are perfectly fine to do, and then I have a statement to make after that.
Spreading, a trade in which you simultaneously buy one futures contract and sell another, is a popular strategy among those trading many different asset classes. One reason they are popular is because they can be less risky when compared to outright futures. And because they are less risky, they also tend to have lower margin requirements. In this lesson, we'll look at the various types of spread trades, including the features that make them valuable strategies for both hedgers and speculators alike. Spreads can be categorized in three ways: intramarket spreads, intermarket spreads, and commodity product spreads. Participants who use these strategies are more concerned with the relationship between the legs of the spread than the actual prices or direction of the market. Let's take a look at each of these. Intramarket spreads, also referred to as calendar spreads, involve buying a futures contract in one month while simultaneously selling one in a different month for the same contract. One example would be buying the March 2018 Euro-Dollar future and selling the March 2021 Euro-Dollar future. Calendar spread traders are primarily focused on changes in the relationship between the two contract months. The goal of this strategy is to take advantage of those changes. In most cases, there will be loss in one leg of the spread, but a profit in the other leg. If the calendar spread is successful, the gain in the profitable leg will outweigh the loss in the losing leg. Calendar spreads are also used by hedgers to roll a futures position from one month to the next. Intermarket spreads involve simultaneously buying and selling two different but related futures with the same contract month in order to trade on the relationship between the two products. For example, the gold-silver ratio spread is a tool for trading on the relationship between gold and silver futures prices. This spread can be viewed as an indicator of the health of the global macroeconomy. Market participants can express their views on the economy or the relationship between these two products by utilizing this spread. Commodity product spreads involve buying and selling futures contracts that are related to the processing of raw commodities. For example, the soybean crush, which involves buying soybean futures and selling soybean meal and soybean oil futures. The participants in this spread are able to simulate the financial aspects of soybean processing. That is, buying soybeans, crushing them, and selling the resulting soy meal and soybean oil. The soybean crush spread allows processors to hedge their price risks, while traders will look at this spread to capitalize on potential profit opportunities. As previously mentioned, one of the attractions of spread trading is the relatively lower risk versus outright futures positions and the subsequent lower margins. Let's see how this works with the soybean corn spread. Assume the outright margin for soybean futures is at 3,000 and the outright margin for corn futures is at 1,500. Rather than posting 4,500 to trade a spread on these two contracts, a trader may receive a 75% margin credit. In other words, the initial margin would be 1,125, which reflects the lower risk in spreading the two contracts, as opposed to trading each of them outright. There are many spread strategies that allow market participants to manage risk and capitalize on potential opportunities. You can learn more about product-specific spreads in other lessons in this course.
Okay, it's important to understand that every prop firm and company have different risk tolerances and rules. Even though it's legal to do, perfectly okay with many other prop firms like Top Step and others, the hedging correlated instruments is not permitted here with Apex. Okay, so just make sure. The big thing, even not only can you not hedge the exact instrument, which you can do if you don't do the same price. It's called a wash sale, or another firm called it something else. You cannot do that cross trade where you're selling the MNQ and buying the MNQ at the exact same price. That's forbidden. But according to TradeStation, you can buy the MNQ and sell the MNQ in different accounts at the same time, as long as you're not cross trading. NinjaTrader calls it wash sale, buying and selling at the same exact price. All right. But the hedging, which the video shows, you can do. And right here at Apex, though, however, it says right here, meaning contractors cannot be short the NQ and long the ES under any circumstances. And you know the videos I've been making, I'm basically short the ES or the MES and long the NQ or MNQ. Those are the micros for those in two different accounts or even in the same account, which is perfectly legal, perfectly fine, unless it breaks the rules of the prop firm that you're trying to get a payout. Now, with the Apex accounts that I'm doing this with, basically they're a little bit more lenient on passing the prop firms, the challenges. But when it comes to a payout, I'm sure they're not going to let you have a payout if you do that. Dollar cost averaging, they're not going to let you have a payout if that's your style, your system. Hedging, they're not going to let you have a payout if that's what you do mainly. So I'm just doing this to demonstrate the technique, to get familiar with it, to try to learn it myself. And if I decide to do it long term, I will be doing it with, obviously, if I want to pay out and make money, not with Apex, but with NinjaTrader or my own personal account money, with accounts that I have at TradeStation, even Charles Schwab. You can do it almost anywhere, I think, other than Apex. So hedging, just be aware of that. If you want to stick with Apex and you only have one strategy, you're not going to be able to use the hedging strategy. So have multiple strategies, even multiple prop firms, different accounts spread across. And you shouldn't have all your money in one account. You shouldn't have all your money in one place anyway. That's just why. Spread it out in case something happens. But that's what I plan on doing. Spread it out. Abide by the Apex rules. Perfectly fine. And I just want to give you guys all a heads up. Yes, I'm using the Apex accounts right now. I'm passing them. Still, I've only passed a couple. But if you want to get a payout in the big picture after you pass them, this strategy cannot be used at Apex. All right. So I just want to disclose that with you guys and make sure you all understand that. Peace.